Find a better business anytime at bbb.org.
Well, good morning, everyone, and good afternoon for those a little bit east of us. Welcome to our monthly Wednesday webinar. We'll still wait a few minutes to see if any more participants join us. Todd Lannon, where are you from?
Originally from Florida, but I live in Albuquerque now.
Your name sounds familiar. Where you work?
Well, I run a company called Lannon's Lawn and Sprinkler, but I was in the Army National Guard here for about 20 years.
No way, Todd. And well, you are one of our new accredited business, and I was going to even reach out and call you when I saw your application for welcome to the Better Business Bureau.
Thank you.
And thank you for taking advantage of one of your benefits so soon. And I do remember you in the Army National Guard.
Oh, good. Were you in the Guard too?
I think so.
Were you? Is this Colonel or General Baca?
Yeah. Colonel, yes.
I remember you. Yeah, I retired a major about 3 years ago.
I remember you, Todd. Well, congratulations, and there is life after the Guard, and I think it's you and your spouse together.
She'll be up here in a second. Yeah.
Oh, well, welcome to being an entrepreneur. And this is a great.
Let me remind you what I look like again for a second here. There we go.
Yes.
Good to see you.
How are you?
And
Cindy Davis, her brother-in-law just retired from the Guard, and he was brigade. You probably worked for him.
Was it
Colonel Calhoun?
Okay, yeah, Calhoun and I are good friends.
Yeah.
Tell Mike I said hi. We ran officer candidate school together for years.
What a small.
I know, that's crazy.
I saw your name come across. I knew it.
What a small world. How funny is that? Love it though. Love it. Good to see you all.
Good to see you.
Another thing for Colette to give me a hard time about. No.
No, you're right.
Well, good morning, everyone, once again, and welcome to our monthly Wednesday webinar. And we do have a treat today, and I am so excited that we have really my boss this morning. She is the chairwoman of my board of directors. I think she's been on the BBB board close to 20 years now. I know she's been on the board long. I know she was on the nominating selection committee that when I got selected 11 years ago. And I'll let you know, Cindy, you have been a true mentor to me through my 11 years, and so blessed that our paths are able to cross. And so we have and Todd, he's one of the kind of what this subject is about with the entrepreneurs and trying to stay, you don't ever want to be in the crosshairs of the IRS. And this, even for a new business, is very critical. And even for businesses that have been going on for years and years, Cindy has a lot of important information on navigating the tax pitfalls of starting your own business. Thank you so much for being with us today, Cindy.
Thank you. I told Brian and Austin that I haven't done this in a lot of years, and I am new to the webinar world, so bear with me. I am a fast talker in general, so I will try to not go too fast. I do want to preface my comments with this should in no way be construed as tax advice. You should contact your own CPA or tax preparer to follow up on these items, and it's definitely not legal advice, as it's illegal for CPAs to practice law in the state of New Mexico. So, but I'm just going to do kind of an overview. I want this. There are so many detailed nuances. I tell all of my clients, my tax answer is always, it depends, because there's very rarely a straight answer that is a yes or no direct answer to any question. There's going to be a lot of conversation and follow-ups to understand your specific nuances, because that's how tax law is. And there's always the you don't know what you don't know. So I like to ask a lot of questions before I give specific advice. My goal for this hour is for this to be kind of an overview for you to take notes of areas that pique your curiosity or maybe give you a little heart palpitation, and follow up with your legal and tax advisors on those items. I did watch last month's presentation. And I don't want to be redundant, but some of the things I'm going to talk about are going to go over that as well. So if you haven't watched last month, you could watch it on YouTube still. Fiona did a great job talking about kind of entity selection and the consequences of that. So because that has a huge part in the pros and cons of starting your own business. We'll cover some of those, but we're not going to belabor the points that she made last month because she did a great job covering those. The other thing I want to do is take this opportunity to tell Brian that we're very sad that he's retiring, and I will certainly miss him. I definitely remember interviewing him, and I'm glad we've gotten to work together all these years. So we'll just start off with people start a business because they're good at something, whatever it is, or they have an interest in something. The problem is you create tax issues that you're not even aware of. And so it's very important to start on the front end with good advice and good planning and professionals that are in your corner to help you. And so that's what we want to do. We want to talk about these pitfalls. Another plug for the industry, if you will, please hire a good bookkeeper, or if your wife is going to do your books, please ensure that you guys can work together well, and she's able to accurately record your stuff. We do sometimes have clients who say, well, my wife keeps the books, and sometimes that's very good news, and sometimes it's not as good of news. So be aware of that on the front end. Again, I know that you're starting a business because you're very talented at something, and unless you're starting a bookkeeping business, it's probably not at these items that can bite you if you're not careful as you go in. So we're going to briefly talk about the ownership structures, the gross receipts tax. If you'll advance to the next one, Austin, thank you. What are the best quote unquote deductions? Some employee issues that you should consider, the employee retention credit, just because that is currently a very hot topic. I know we've all seen those late night ads about the employee retention credit, so we're definitely going to talk about that. And then we're going to talk briefly about some 2023 changes that, Austin asked me today about the gross receipts tax. Yes, it changed as of July 1st. In general, it probably went down half a percent or half a cent where you are, but that's one of the things we'll talk about. So as far as ownership structures, again, this is what Fiona covered last month, and she did a very good job talking about them, and it's a little bit complicated to talk about. So if you'll go to the next slide, the reason it's complicated, and Fiona talked about this, is there's a difference between how you're registered with the state and how the IRS sees you as an entity. So there are limited liability companies, those can be single member or multi-member, and that is a whole convoluted issue. There's corporations, and then there's sole proprietors. And as I said, these can be kind of mixed matched. A limited liability company, that is how you register with the state. And so if you, I'm not going to read the slide to you, but this is pretty much the simplest structure to set up, and it has a lot of flexibility within it if this is the structure that you choose. All right. And so the types of LLCs are single member or multi-member. Now, both of these have what's called a de facto tax treatment from the IRS. As I mentioned, this is how you're registered with the state. It's a state's legal construct, the limited liability company. So there's not an LLC form to file your taxes on. The IRS taxes you based upon whether you have one member or multi-members, or if you've made certain elections. So the single member LLC, and in New Mexico, because we're a community property state, it can be you and your spouse. That is still considered a single member LLC. It can be a disregarded entity, according to the IRS, which makes it very similar to a sole proprietorship on your tax return. So that's the de facto tax treatment for the single member LLC or in New Mexico community property state, a married couple. And it doesn't matter if you're married, again, because of the legalese. I have clients who tell me, well, we're married, and you say, how long? Well, we're not actually married. Okay, well, that, again, that changes my tax answer. So that's why I told you to depend on the front end. The multi-member LLC, the de facto tax treatment is a partnership. So if you and your kids, or you and your buddy are going into this venture together, and there's multiple members in your LLC, then the IRS says you're a partnership. You can make elections to be treated otherwise, but that's the de facto treatment. So then the simplest of all organizations is the sole proprietorship. Oh, I'm sorry, I missed corporation. Corporations are a little more complicated. Again, this is how you register with the Secretary of State as a corporation. In New Mexico, you're required to hold an annual meeting if you are a corporation, which sometimes somebody has registered their business as a corporation and it's just them individually. So they're not careful about maintaining the restrictions around being an actual corporation. And when we talk about corporations, people are very familiar with the term S corporation. Well, again, S corporation is only on the IRS side. That is not a state registration. That is an IRS election that a corporation can make or an LLC can make. So that's why this is it's hard to draw definitive lines when we're talking about entity structures, because they kind of merge together in some ways, and sometimes they overlap. Sometimes they're one thing and can be chosen to be a different thing. So it's hard to draw real hard and fast lines around these. But a C corporation, they're the oldest kind of business model. Their big downfall that they get criticized for often is the double taxation. So that people try to avoid that oftentimes. So they may be a corporation registered with the state of New Mexico as a corporation, but they want to operate as an S corporation. But as I mentioned earlier, also an LLC can be registered with the state as an LLC and choose to be taxed as an S corporation. So that's kind of where we're getting into these Venn diagrams. So then the next and most simple type of organization is the sole proprietor, which, you know, is somebody in their garage doing something. Again, consult your legal advisor, but from a liability standpoint, depending on what you're doing, you may want to go ahead and register as an LLC with the Secretary of State, even if you're just, you know, somebody doing something in their garage. You definitely need to most likely register with the city that you're in to get a business license. And you should probably consider gross receipts tax, but we'll get into that. That's our next point. Gross receipts tax, that's what it's called in New Mexico. So most of us are familiar with that nomenclature. It's our equivalent of a sales tax, but legally they are kind of a very different beast. So in New Mexico, we have the gross receipts tax. And most entities are subject to the gross receipts tax. If you're setting up a business, you should probably register. If you'll go ahead and go to the next slide, Austin. So it is pretty well described by itself in that it is a gross receipts tax. The gross amount that you take in, your total collections, is subject to this tax in most cases. Unlike a lot of states, New Mexico taxes services. So that's something that, especially for transplants that maybe have operated a business in another state and they moved here and thought they could operate a similar business, they are very unaware of the gross receipts tax implications. So this is an area that like I said, it often bites people, and sometimes they don't realize, excuse me, until they receive a notice from Taxation and Revenue. It's called a matching notice, that they're even subject to this. And at that point, then they go to an attorney or a CPA trying to get the problem taken care of. And so this is something that whether you're brand new or you've been operating your business for a while, this is an area you definitely want to have a focus. If you go on to the next slide, as I mentioned, it's pretty broad. We have carved holes in it over the last, few decades. The initial theory of the gross receipts tax was that everything was gonna be subject, and so there was gonna be a very low rate. As we made carve outs, we've had to increase the rate, and so it's not quite what it originally was. I can go into some history, but that would probably, only tax nerds would be really interested in that. Suffice it to say that our tax rate is not low any longer. Austin was, again, as I mentioned, asking about the rates, and he said, where's the highest rate? In some parts of the state, it's nearing 9%. So we have a state flat rate that, and then there can be local add-ons, county, city, divisions within the city. So it's also important to know exactly where your tax cells are taxable. And those can change in January and July of each year. So make sure you're up to date on what the current rate is at those dates. So the things that are subject to the gross receipts tax are listed here, but as I mentioned, performing services, that's kind of an oddball for people who didn't grow up here. That New Mexico is rare, although as we're moving more to the service economy, states are more increasingly starting to tax services. So then if you go to the next one, so yeah, this says that the top rate actually is 9.3%. And so yeah, this is kind of the stuff I already just said. I apologize. I should have moved further. Okay, so our next topic is the quote unquote best deductions. Everybody wants a tax deduction that comes out of thin air, the magic tax deduction, for which they get a deduction on their taxes and it doesn't cost them any money. This is one of our favorite comments. You write it off. Well, how do you write it off? The write-off people. So this is obviously only probably tax nerds think this is funny, but we find it very funny because that's what people do. I want to write. What can I write off? Well, so if you'll go on to the next slide, a write-off or a tax deduction is actually an expenditure. You actually have to spend money. And there's no case where your tax rate is 100%. So in all cases, you are spending $1 and you're saving the tax effect of that dollar. So possibly as high as 40%. But so you're still spending 60 cents out of pocket for something. So that's why, I come from a farming community, so, everybody wants to buy a new truck at the end of the year or a new tractor, and that is great. If you need a new truck or a new tractor, you should buy it. I always also advise my clients, don't let the tax deduction or the tax treatment or the tax policy run your business for you. Let your business run in the way it needs to run and be effective, and use your tax advisor to help you make the tax advantageous decisions where you can. But in all cases, do the thing that makes sense for your business. So I'll pick on my dad a little bit. He is a contractor, and so he always wanted a new truck because everybody would buy a truck, and it's like, that's great. But you spend, let's say, $100,000 on a truck, you save possibly $40,000 of tax, you're still out the $60,000. So the tax deduction of that truck does not make the truck make sense. It has to be a business decision to make it worthwhile. And so that's why you should, there's no magic deductions. There's only ones that actually cost you cash. And so you should make the ones that make sense for your business and the way you're running it. The other thing I will say about tax deductions is keep a very good record. The preference is always to have a separate business account and personal account, and to only run business expenses through your business account, and only run personal expenses through your personal account. There can be some crossover, but it definitely muddies the water, and it makes your bookkeeping more difficult. It makes your tax reporting more difficult, and consult your tax advisor, but it could also make your legal situation more difficult if you have mixed your personal finances with your business finances. So always keep them separate. So the best deduction is the SEP. If you are in a position where you could have one, a corporation cannot do a SEP, which is a simplified employee pension. This is the biggest bang for your buck. Even if you're listening to this and you're an employee, the biggest bang for your buck is to max out your 401k if you have one at your employer, or to do an IRA if you don't have a 401k plan at your employer, or a 403b plan if you work for a governmental entity. That is the best tax deduction, because that dollar that you're spending goes to you tomorrow. In all these other cases, you're buying supplies or you're buying that new truck, you're giving the car dealer or the office supply store your dollar, and you're saving 60 cents. In this case, you're giving your retirement account that dollar. So it's still your dollar, and you get the tax benefit of possibly 40% of that dollar. So that's why if you're a sole proprietor or an S corporation and you can do a simplified employee pension, you can do a lot of money if you're profitable. Sorry, again, it depends. The caveat is you must be profitable for you to be able to make a SEP contribution. But this is the biggest tax deduction that is the best one, because it goes to you tomorrow. But as I mentioned, even if you're just an employee, or you know, so that in that case, do your 401k, the most you can afford to do. Because again, people say, I want to save on my taxes, what can I do about my tax bill? Well, contribute $19,000 to your 401k. Well, I can't afford that. Then you can't afford the cost of the deduction. That's the painful truth of deductions. So again, that's why I put that in quotes.
So it's even more beneficial when an employer has a matching program.
Absolutely. So now you have free money. So you put in your contribution. Most employers that match 3%. So now you also have free money in your tomorrow pocket that didn't cost you anything. It doesn't give you a tax deduction. It gives your employer tax deduction, but it helps you, and that grows. So the younger you are, when you can start doing that, that is the best tax deduction. All right, so the next thing I wanted to talk about is employees. There's a quote here from Michael Jordan: "Talent wins games, but teamwork and intelligence wins championships." Again, another plug for your advisors. As I mentioned earlier, you don't know what you don't know, and so having an advisor who basically lets you be like a kid in a candy store may be great in the interim, but in the event you get audited, it may not be such a good answer at the end. So you want to make sure that you have a good team of advisors around you, and then also your employees. You can't do all the work yourself. You need people. And this is another area that I think people often get bad advice. And I have clients come to me and say, well, I'm a contract worker. Really? Calling someone an employee versus a contract worker is not a tax decision. It is not a management decision. It is literally a facts and circumstances test that is not subjective, it is objective. So if you go to work for someone, or you're on the other side, you're the employer hiring someone, don't tell someone you'll be a contract worker if they're actually in fact an employee, because there are penalties associated with misclassifying employees. It's more expensive to have an employee, so that's what employers would prefer. Sometimes that's what employees would prefer, or workers, I should say, since they're not necessarily employees, but that's what a worker may want, especially since the 2017 Tax Act. Unreimbursed employee business expenses are not deductible. So I may prefer to be a contract worker. So I can deduct, if I'm working from home, I can deduct the printer I put in my paper. If I'm just using my personal paper for a regular job and I'm just an employee, that's not deductible. But if I'm a contract worker and I'm providing services for multiple companies, then maybe I am a contract worker and now I have my own business. And now all of a sudden this whole discussion matters to me because I'm starting my own business and I didn't even realize it because I'm a contract worker. Again, it is not subjective, or it should not be subjective. If you have an employee that you are directing what they do, where they do it, how they do it, you're providing the equipment they do it with, that's your employee. If you have someone who says, yeah, I'll come in, and even if they're providing secretarial services, which you might think would be an employee's job, if they say, I'll come in when I can, 3 hours a week, gather your paperwork, and I'll take it to my house on my computer when I get around to it, now that person's a contract worker. It obviously gets, there are obviously cases where it's not that cut and dry, but there are 9 factors, according to the IRS, that determine whether you're a contract worker or an employee, or whether as an employer you have a contract worker or an employee. So this is a very important area that, as I mentioned, I've had individuals come in and say, well, I get it to 99, and it's like, you're not a contract worker, you should have gotten a W-2. They should have withheld, they should have paid part of your social security. I mean, it's a big deal. And so this is an important issue that comes around when you have somebody besides your wife working for you. Okay, if you'll go to the next one, the other thing that obviously has become a huge issue in the last few years are remote employees. That used to never happen. And now, you know, people that work for huge companies don't live near where they work. And actually, I have smaller companies who have employees who don't live where the operations of the business take place. They're working from home remotely. It is very good. It's allowed a lot of flexibility for workers to be able to live where they want and still work where they want. But there are pitfalls here as well that you should be aware of. In most cases, you need to register in the state where the employee resides. What that means is now your business is also taxable in that state. It depends on what kind of services. There is a caveat for people who are only soliciting sales that may not necessarily give your company what's called nexus in that state. But if you have an employee providing administrative functions in Virginia and you're a New Mexico corporation, you now also must file New Mexico or Virginia withholding, because that employee is going to pay income tax on that wages in Virginia. So you have to do their Virginia withholding, and your company now has to file an entity level return in that state, because you're going to be what's called apportioning income to that state based on having nexus in that state. So this is another thing that in the last few years didn't used to be a problem. If you were a New Mexico company, you know, you mostly have New Mexico employees. And this is a thing that in the last few years has gotten money. And the problem with it is that because it's an evolving area, it's constantly changing and every state is different. So this is an area that can get very ugly very quickly.
Well, since the pandemic, you know, with remote workers and hybrid operations, and then coming back from the pandemic, and
Right.
maintaining brick and mortar still, you know, we've been fortunate enough that I've still had, you know, I have an employee in Texas, in Houston,
Yes.
and in Florida. And I know what you're talking about, because we had to do, and we're fortunate that, you know, and we used to have Arkansas too.
Right,
Texas and Florida don't
Don't have state,
state.
right, for individuals don't have state income tax responsibilities.
We have to do all that. thing.
Yes.
So,
Yes, so the waters can get very muddy very quickly. And you think all you did was, you know, hire somebody to do something in their house. It's like the ramifications of that. And I've had clients say, oh, forget it. We're firing them. We're not ever doing this again, because it is just adds to your compliance burden. And depending on the magnitude of your company and the value of this person, it may not be worth it to you. Again, from a business decision, to decide whether or not that person is valuable enough for the tax consequences of having that person do that. So the other thing, a relatively new issue with having employees in New Mexico. So if you're listening from outside of New Mexico, please be aware of this, the Healthy Workplaces Act. If you'll move to the next slide, Austin.
Sorry.
It's okay.
We started.
Okay.
If the employees leave and they're only one employee in that state, are you able to leave that state tax wise?
Yes, yes, you can close all of those accounts and do final filing and not have a continuing burden there, yes. So one of the issues is the Healthy Workplaces Act. I think most New Mexico employers are familiar with this, although I do, one of our employees, their son was working at a summer job and he had a orthodontist appointment and asked his employer for his leave, and they said, no, we're not doing that. Well, he's worked more than 30 hours for them. They absolutely are required by New Mexico state law to provide 1 hour for every 30 hours worked for Healthy Workplaces Act leave. This is, so if you're outside of the state of New Mexico and you have an employee here, it applies to you. If you're here and you're not aware of it, it applies to you. And it's very expansive. And again, this is very new. I think it just came in last year, or so I guess in 2021. So it took effect in 2022. It was passed by the legislature in 2021. So it started last July, and it has very, very broad application, serious ramifications if you're not following it. And one of the things is, the person only has to request it. I tease because the language in the law is very broad. It can be a direct family member, an extended family member, or someone that is akin to a family member. So if it's like your auntie, you can take family leave for a situation involving them. So I think there's probably potential for abuse here, but be very careful as an employer. And if you're an employee, be aware of what your rights are and that you are entitled to this, even if you're just a kid working a summer job.
Right.
You are entitled to this.
That's a big thing, and includes part-time employees that aren't otherwise covered under health benefits as full-time employment.
Absolutely. So, I have a client that's a farmer that has seasonal workers. Every 30th hour, they get an hour of paid leave. So this is another area that you should be very careful about. Make sure you consult your advisors on how it applies to you and how to track this, because that's obviously another issue is depending on the number of employees you have, tracking it and start dates and how much they can use each year is a very complicated area. Okay, we will move on to the employee retention credit. Be aware of scammers. There are companies who are aggressively marketing this. Every 2 weeks, the AICPA, the American Institute of Certified Public Accountants, does a town hall. And I can't tell you how many segments they have dedicated to saying, we are talking with the IRS is aware of these aggressive marketers. This is an amazing credit if you qualify. If you qualify, you should definitely claim it. And you have until next summer. So, sorry, let me start with the overview of that, I guess. From March 12th, 2020, when everything started being closed down due to the pandemic, through September 30th of 2021. It's on a quarter by quarter basis. It's again, this is an area that is very complicated. It may be difficult to calculate because if you had the PPP loan, those wages don't qualify, but possibly for that period from March 12th, 2020 to September 30th, 2021, you may qualify for the employee retention credit if you had employees. And it's a very good credit. It is very lucrative for 2020. This is the other thing that makes this very complicated is that there's three, I've been told I use this word wrong, but there's 3 tranches of ERC, and by division, they have different rules. So it's very complicated. But for 2020, from March 12th to 12/31, you could get possibly up to $7,000 per employee. For January 1st, 2021 to September 30th, 2021, you could possibly get $10,000 per employee per quarter. So large employers, I have clients who have received millions of dollars from the employee retention credit. So it is a valid credit. If you qualify, you should go after it, absolutely. You should engage a reputable professional to do that for you. Because as I mentioned, the calculations are difficult, especially if you're a restaurant and you have restaurant revitalization money, if you've got a PPP loan. There's all these time periods and it's on an employee by employee basis. So it can be a very cumbersome calculation. And if you don't qualify, I would not recommend that you claim it, because the IRS is aware of the aggressive marketing and have said that they will go after people who fraudulently claimed the employee retention credit. Because it's so much money that if you don't qualify, it's very tempting, but the IRS will go after you, they have said. Now, again, this is a relatively new and developing area, so we haven't seen these cases yet, but I think for years to come, we will probably see litigation around this, the IRS going after people who didn't qualify. I probably don't need to go into any more detail than that, but that's the employee retention credit. So the next thing is 2023 changes. For the first 2/3 of my career at this point, probably will eventually only have been half of my career, tax law was relatively stable and things didn't change a lot. There were some inflation factors that increased each year, but since the 2017 Tax Act, tax law has been changing rapidly at the federal level and exponentially at the state level. So you really need to stay abreast of the issues that impact your industry, whatever it may be, because things have just been on, greased rails since that 2017 Tax Act. Things have changed, things that always have happened. For example, the research and development credit, it got extended every year. It was just one of those things you knew by the end of the year it was going to get extended. In 2022, it didn't get extended. And everybody said, but it's going to be extended. We all know this is just going to happen. Well, we're in July of 2023 and it has not happened yet to be retroactive for 2022. So now we're filing 2022 returns and we know what the rule currently is. We know what we think the rule is going to be, but we don't know. And so that is an added complication that has happened in the last few years where things get passed retroactively. For example, going back to the employee retention credit, it was initially supposed to go through December 31st, 2021. However, in, I believe, the first part of October 2021, they retroactively canceled it as of September 30th, 2021. So retroactive bills are being passed at a rate never seen. So you can never, that's the other thing about my job, why I have to tell my clients it depends, because I can tell you what the rule is today. I cannot tell you if tomorrow, today's rule is the same. It just is evolving faster and faster. And unfortunately for small business owners, it's making it more and more difficult to stay in compliance. So going to the next slide, just a couple of the things that are new. Bonus depreciation has been around since the 2010 Tax Act, and it has gone up and gone down, but it's been 100% for the last several years. For 2023, it is only 80%. So that is, that's a game changer. Again, going back to your deductions, if you buy a piece of equipment, for the last, and I should have looked this up, but I didn't, however many years, you could have deducted 100% under bonus depreciation. If you go in with that same assumption for 2023, now all of a sudden you have 20% you're paying tax on. You can still depreciate that over the next 5 years if it's 5-year property, but you don't get the 1-year hit like you have for the last several years. So that is a big change. I mentioned the 401k contributions earlier, so that's up to $22,500 for 2023 that you can contribute. So if you just have a percentage of your salary or a flat amount of your salary going into your 401k plan, you should get with your HR people, if you can afford to, and get your deferral up to the $22,500 for this year. And if you're older, if you're over 50, you get a catch-up contribution too. But you know, that's a $2,000 increase from 2022, so don't just let things ride, I guess is what is the point of that. Don't say, well, I've always done X% of my salary or X dollars. These things change every year, and so if you're trying to take the best advantage of them, you need to be proactive and make the changes commensurate with the law changes. Solar energy credits are another thing that changed pretty drastically for 2023. So, you know, if you are in the process of that, there's a federal credit and there's a New Mexico credit. The New Mexico credit is a little more fickle because in New Mexico, it's a fixed amount per year. So you have to get your application into the Energy, Minerals and Natural Resources Department before the year's allotment is up, or you get zero. So again, if you're planning a solar project and you think you're going to get a state credit, you need to make sure you follow the steps to ensure you get on the front end of that, and don't do this thing thinking you're going to get a state credit and find out that the state allotment has already been used up for the year. All right, so just in summary, choose the most beneficial organizational structure for your business, and that may change over time, and that's okay. We have a lot of clients who start with the LLC because it's relatively easy to set up. They can operate it as a sole proprietorship. In a few years, they have a trusted employee that they want to bring in as a partner. They bring them in, now it's a partnership. Now we may want to make an S election. So there is something, you can evolve some in your structure, but make sure you're not choosing the 800-pound gorilla when you need a pencil, and vice versa. Don't use a pencil when what you need is the 800-pound gorilla. Understand GRT and how that can get you, because the problem with the GRT is that the state can come back effectively almost 6 years. And so you get a notice and it goes way back, further back than you thought. And so, you know, now you need to have your records to support your position and all of that. So just be aware that that's an issue, and try to get in on that on the front end. Figure out what deductions you're eligible and use them to your entity's advantage. Buy the new truck when you need the new truck, but don't ever buy the new truck just because of the tax deduction. Do you have employees? What does that mean for you? And do you have employees or do you have contract workers? And again, this is it's an important issue to look at and to correctly assess, because there's penalties if you don't get it right. If you have employees, if you had employees during 2020 and 2021, and you qualified for the ERC, the easiest way to qualify that for New Mexico businesses, especially, one of the qualifications is if you were required to be closed due to a governmental mandate, even partially suspended. So either of those get you in as qualifying for that particular quarter. So, you know, unfortunately for me, accountants were an essential service, so we were never required to be closed. So we didn't qualify on the governmental shutdown provision of the ERC, but look into that and find a trusted advisor to help you look into that. And again, laws are constantly changing. So be aware of that, and, you know, always read the new stuff, what's new. And one of the difficult things in New Mexico is that, for example, the Healthy Workplaces Act was passed in 2021. It didn't happen until July of 2022. And so I think we all, as New Mexicans, tend to procrastinate maybe. And so you don't look at it until it's actually becoming effective, when you should have made plans. The same thing happened a couple of years ago, the gross receipts tax. Back to that issue, sourcing changed, and it was deferred for over a year, and so nobody looked at it at all until it was effective. And there were a lot of serious questions that needed to be addressed, and record keeping within businesses that needed to be addressed because of the sourcing of the gross receipts tax to each location and the number of locations we have. That just makes it a more difficult thing. So what is happening in New Mexico? Pass-through entities. If you are an S corporation or a partnership, those are called pass-through entities, because the tax is paid at the individual level, not at the entity level. So beginning in 2020, I also lived in the past. I'm currently working on 2022 returns, even though we're halfway through 2023, so I have to remember what year we're talking about. So beginning for 2022 returns, you could pay that tax at the entity level, which may or may not. We've done calculations for clients. Some clients it makes a huge difference, and some clients it would be a negative impact to pay that tax at the entity level, but you should be aware of that. The capital gain deduction, again, it's something that has been kind of a mainstay for the last at least 5 years, was a large capital gain deduction. For 2023, that decreases pretty significantly. Up to it's only up to $1,000 or 40% of the gain if it's a long-term asset sold in the state of New Mexico. A good thing that happened, also again new for 2022, is if you are retired from the armed forces, there's a deduction from your taxable income. It was $10,000 for 2022. It's $20,000 for 2023, and it goes up to $30,000 for 2024, and then it goes away. So unless there's legislative action, this is a 3-year benefit that will go away in a cliff. So you've maybe gotten used to not owing New Mexico income tax when you do your income tax return, and then all of a sudden, when your 2025 return is done, you owe tax because you've been expecting this deduction that is increasing each year. The other thing that was new for 2022 returns was that Social Security, taxable Social Security is not taxable in New Mexico. So on your federal return, a certain percentage of your Social Security income is taxable based upon your income level. In New Mexico, whatever amount is taxable at the federal level is a deduction on the New Mexico return. And this is something that our software didn't get right until way into tax season. It's not the whole amount of Social Security. It's just a taxable amount on your federal return. That's a deduction for New Mexico. So, are there any questions?
No, I'm good. Thank you.
All right.
And no questions in the chat box there, Austin?
Not right now.
Yeah, I know we went kind of 100 miles an hour, but
Well, thank you so much, Cindy, for a great presentation. Such invaluable information and so much to business need to take caution of, to stay out of trouble and stay on the good side of the IRS. Cindy Davis is one of her business, is one of in our accredited business, one of our 3,400 accredited business. Cindy is a shareholder and partner of Peltier, Gustafson, and Miller. And so glad and fortunate that you're able to spend some time with us today, Cindy. Thank you.
thank you. Thank you.